about the 15 riskiest housing market. We should talk about what happens if a recession or not a recession. But folks, first today, we are going to start with the one and only Ryan Pineda. Yes, folks, Ryan Pineda from Wealthy Investors was nice enough to have me on his YouTube channel. That video dropped Friday morning. I want to shout out all the One Rental at a Time fans that were nice enough to watch that video. It's 90 minutes long, roughly, and we get to talk about the difference between being an entrepreneur and being an employee. We have several shout outs in that interview for the W-2 employee. I am not lost on the fact that a lot of my viewers are W-2 employees. In fact, it is my avatar, if you will. And it was a lot of fun to talk with somebody who I think is a natural-born entrepreneur like Ryan, where I am just an employee. And we got to chop it up and talk about how you can, with one rental at a time, have a better future with four, or if you keep going, have a financial freedom. We also talked about my 3 steps to getting wealthy. So I want to once again publicly thank Ryan for having me on. I would love to come back sometime in the future if he feels the interview was worthwhile. So Ryan, thank you very much. Folks, if you want to get into that video, watch it. I will say, he asked me questions that I've never answered before. So there's a couple of tidbits in there of new information. If you want to check it out, go give him a follow and leave a comment. I'm doing my best to go back and say hi to all the One Rental at a Time fans that leave a comment. So thank you very much. Next, let's talk about a recession or no recession. And really what I want to talk about with recession or no recession is first and foremost interest rates. Because I think at this point there is a natural understanding that if there is no recession, aka soft landing, the Fed will keep rates higher for longer. Now, what does that mean? That means we are at or very near what will be the terminal rate. If we have no recession and nothing in the financial system breaks, it is very likely that the Fed will hold rates this high for at least a year. At least a year, if not longer. I know there's a lot of hope in the market that there would be a cut in December. It is not happening if we have no recession. If you flip that over and we have a recession, frankly, the Fed knows the playbook. If the economy goes negative growth, we have a recession, we have higher unemployment, we have consumers pulling back, the Fed cuts rates, right? This is where we are at. The job market is still very strong. I think we're under 9.5 million job openings on JOLTS. Unemployment is 3.6. I believe wages for the employee are going to see years of growth. So it will be very interesting. In a housing market where inventory is at near record lows and transactions are close to 4 million, I don't think we have price degradation either way. In fact, I don't think we have the only way we have significant price movement, in my opinion, is if rates get in the 5.5 range. 5.5 is not low enough for most people to move, but it is low enough to pull demand back. So I think 5.5% mortgage rates is very, 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 very unhealthy, in my opinion. I don't think we're going there, but I wanted to share my thoughts. So again, if you are in the recession camp, the fix is lower rates. If we are in the no recession or soft landing, the Fed could stick the landing and we have higher rates for longer, which means at least 12 months. So again, lots of stuff going on there. How about the 15 most risky housing markets? Shout out Lance Lambert, man. If you're not following Lance Lambert on Twitter or reading his Fortune articles, you're missing out on a wealth of information, some very thought-provoking information. So Lance Lambert just put out an article where, with the help of Morningstar, so shout out the team at Morningstar as well, Lance talked about the 15 riskiest housing markets and the 15 least risky housing markets. And what I love about this article, and it's so Lance, it's just so Lance. It's not feelings. It's not gut feelings. There's actually solid logic. Again, shout out Lance and the team at Morningstar. So to get into this, these are the factors that drove the most risk and the least risky markets. I will list all 15 risky and all 15 not least risky. So affordability, negative population growth, inventory, active inventory rising, and days on market rising. That is exactly the solid logic. Okay, wait. So affordability is low, population shrinking, active listings growing, days on market growing. You get those four variables, you and I can have a conversation about how risky a market is. So I will ask you right now, if you are watching this on replay, hit pause and tell me what you think the most risky market is. I want to see if anybody can guess it. If you're watching live, you can go ahead and leave your guess of what city it is right now, because I will read, I believe it's 15-1. So the number one most risky city will be the last one I read. But let's get into it. So it starts with San Diego, California, Austin, Texas, Colorado Springs, Colorado, Provo, Utah, Nashville, Tennessee, Oxnard, California, Seattle, Washington, Ogden, I actually don't know where Ogden is. I should have wrote that down. Portland, Oregon, San Jose, California, Honolulu, Hawaii, Los Angeles, California, San Francisco, and folks, according to Morningstar, in the article written in Fortune, the most risky housing market today, according to Morningstar, is Salt Lake City, Utah. Anybody guess that correctly? Salt Lake City, Utah? I thought that was very interesting. Not to be outdone. Again, lots of people like to see doom. So we started with the 15 most risky markets. How about we also talk about the 15 least risky markets? Frankly, folks, if you want to guess the least risky housing market, do the same thing. If you're watching on replay, pause. If you're watching live, guess the least risky housing market, and we will do that last. So again, the least risky housing markets: Virginia Beach, Scranton, Cleveland, Akron, Baton Rouge, Wichita, Little Rock, Toledo, Augusta, Rochester, Harrisburg, New Haven, Allentown, Syracuse, and the least risky housing market, according to Morningstar and Lance Lambert, is Hartford, Connecticut. Pretty cool information, I think. So again, 15 least worst. Go follow Lance News Lambert on Twitter. Also read his articles on Fortune. So let's talk about earnings next week that start tomorrow. And we will also review big banks from Friday. I shared with you that I would do that. So on Monday, we start to see smaller and smaller financial institutions. Again, I do not think this earnings season is about the big banks, but I did find some interesting facts I will share in a minute. It is about the little ones. If all of the purveyors talking about banking are right, we are going to see a wave of consolidation. And it's going to be the little guys that get gobbled up by the big guys, unfortunately. On Tuesday, we get some more big banks. We get Bank of America, Morgan Stanley, and PNC. Wednesday, we will get Netflix, United, IBM, Tesla, and Goldman Sachs. Thursday, American Airlines, Johnson & Johnson. And then Friday, AutoNation, Comerica, and American Express. Lots of data coming from banking, lots of data coming from consumers, lots of stuff around travel, tech. It is going to be a wild week to watch, and I look forward to bringing it to you daily. Now for the big banks, what did I read? So again, big banks, Citigroup, Wells Fargo, JP Morgan reported on Friday. I took some time to go through their earnings announcements, and this is what I saw. There was plenty more in there, but this is what I saw. 1, deposits cash fell. These large institutions are not paying savings accounts well. We did see deposit flights. In fact, Citi and Wells Fargo were negative quarter to quarter, and JP Morgan would have been negative if not for the First Republic acquisition. Second, the consumer, generally speaking, appears to be okay. They're paying their bills. We're not seeing delinquencies spike to abnormal levels. Yes, they're up from last year, but they are not up above trend. Net interest margin was still very profitable. Again, net interest margin is we pay us nothing. They lend out at 6 or 7. Corporations, this is one to watch. Corporations are being pretty cautious how they use their cash and how they borrow money. That is a sign of things to come, I believe. And then finally, the investment banking engine is essentially on pause or stalled. Frankly, the investment banking divisions at these big banks need a recession. A recession would ignite these investment bankers as they do consolidations and debt restructures and things like this. A soft landing, probably not very good for the investment banking industries. How about foreclosure starts? They're surging, folks. I'm going to give you some interesting statistics, but pay attention to the last one. I am going to give you a statistic that I want you to write down. Over the next 6 to 9 to 12 months, we are going to see doomers try to scare you about foreclosures. The talk track will be something like this. Foreclosures spike, housing will crash in 2023 or 2024. That will be the talk track. And I am going to give you the inoculation, the medicine, the filter, whatever you want to call it, to block that stupidity and then block that content creator. But first, let's go into the numbers. 1, foreclosure starts increased 13% in the first half of 2023. They are up 185% over 2 years. You have to watch percentages. Foreclosure filings were 185,580 in the first 6 months of 2023. What is a foreclosure filing? Is that a bank repossession? Absolutely not. Absolutely not. How many actual bank foreclosures where the bank takes it back? 22,672. 22,000. 22,000. Foreclosure activity is up 78%. Okay, all of that is true. All of that will be created by purveyors of doom. Again, if a doomer, a crash bro says something like the following: foreclosure activity up, housing crash 2023 or 2024, here is your statistic. Write this down because you're going to need it. The average time to foreclose from first notice to bank repossession, write this down. Ready? 1,212 days. For you math wizards out there, that's 4 years. 1,212 days. So, if unemployment goes to 8% tomorrow and no banks start forbearance periods, the average tenure or duration for a foreclosure is 1,212 days. 4 years. So even if we have an unemployment spike tomorrow and nobody pays their mortgage, the inventory doesn't show up till 2027. All right, At the end of the day, folks, it is time to do the work. I believe a higher interest rate environment is good for investors. In fact, before we get into that, I want to congratulate 2 more folks for getting their golden ticket. What are golden tickets? These are folks that did the work and got their very first deal. Folks, you can only ever get 1 golden ticket. After that, I will be mailing you what's called the black cards to recognize each and every deal you get after the golden ticket. So Ricardo, congratulations on your golden ticket. Your card will be in the mail today. And Mandy, congratulations on your golden ticket. The card will go out in the mail today. So again, folks, I believe it is time to do the work. I believe a slower housing market in the second half is good for us. I believe higher interest rate is better than lower interest rate because demand falls off and you and I could do the work and write great offers. Again, I am now working on my courses. I will be raising the price of both the $399 and the $799 option here shortly. The $399 will be going to $499. The $799 course, which includes a half hour of my time, will be going to $999, which I've shared before. As of right now, you can still buy the course at $399. I will still give you $100 in free goodies. You can pick 2 free courses you want on top of that. You can also join the Facebook group, which lots of folks are buying the course, but don't forget the Facebook group is free. If you buy the $799 option, which again is going up $200 shortly, you will get $450 in free goodies. Do the work. As you saw in my conversation with Ryan Pineda, I think getting wealthy is 3 steps. Create dry powder, disposable income. Become elite at something. My course, How to Get Started One Rental at a Time, is about becoming elite at your buy box. And then finally, time. It's a 10-year journey. Folks, more of you need to buy it. I know the price is going up. It just is. I'm adding more and more stuff. But you do have a short window where you can get a lower price and get the goodies. Ricardo and Mandy, congratulations. Your card is going out in the mail. Now, I am off to do a session with Dan Bird that I'm so happy about. We are doing 3 hours of stock, understanding what's going on in the stock market, looking at different models, risk, and stock. So if you're joining me there, I will see you shortly. Bye.